Polysindirian Berhad was incorporated in Klang, Selangor by a Bumiputera family consisting of 4 brothers to produce polyethylene bags or known as P-bags. The eldest was Mr. Rahim and the other 3 siblings were Mr. Yusri, Mr. Zulki Ply, and Mr. Nordin. The company was later awarded Bumiputera status by the Malaysia Ministry of Finance. Within 2 years of its operations, it was unable to supply the full demand for the P-bags as there was a huge demand from every industry from food to pharmaceutical industries. With future expansion in mind, the brothers decided to move the company from Klang to Alor Gajah, Malacca. The location was advantageous as it was well connected by railways and roadways and had access to a good supply of skilled laborers. The state government also provided incentives through water and tax concessions. All these motivated the brothers to go in for a full production of plastic and polythene-based products, and the company was an instant success. But recently Mr. Rahim had lost a lot of sleep. The meeting he had with his bankers over the loan he had made left him with grief. As the CEO of PSB, he was responsible for every action taken by the company. He decided to invest heavily by borrowing from 2 merchants' banks and even purchased new multi-million ringgit machinery to satisfy the quality and other conditions imposed by a potential customer. The customer, representing a large reputable conglomerate, had verbally placed a huge order. When everything was ready, this promising customer withdrew his order citing his company policy in choosing suppliers. This unexpected decision pushed PSB into a quandary. Mr. Rahim had no written agreement to fall back on and faced a huge loan repayment problem as the new machine could not be used to generate income. When PSB tried to sell this new machine, no potential buyer approached the company. One foreign buyer quoted only 20% of the original cost as the price for the machine, and it leads to disappointment where it could not help the company to repay the debt. The income statement for 2011 and 2012 showed the sales revenue as 17 million ringgit and 16 million ringgit respectively, while the profit before tax stood at 264,000 ringgit, 2011, and 56,000 ringgit, 2012. The finance expenses grew from 352,000 ringgit, 2011, to 518,000 ringgit, 2012. Similarly, other expenses also grew from 2011 to 2012. PSB's equity was stable at 2.5 million ringgit from inception, but the retained earnings increased slowly and the equity was 4.5 million ringgit. PSB financed its production activities in 4 ways. Bank overdraft was highly flexible, but PSB had to pay an extra 1.5% interest than the term loans. The other items were short-term borrowings, hire purchases, and long-term loans. Cash flow statements record only cash flows, unlike the income statement which incorporates accrued items. Cash flow statements are more reliable than income statements. An increase in inventory, accounts receivable and borrowings, and a decrease in accounts payable are all bad signs for the company. In 2012, despite difficulties, the cash position increased to 423,000 ringgit from 51,000 ringgit the year before. But the income statement showed a contradictory view. The cost was important for decision-making, price fixing, and knowing the break-even point and safety level. Approximately 40% of the costs were fixed in nature and they were uncontrollable. The company market is not shrinking and it has a bright future if it ventures into the ASEAN market. This recycling will also earn good revenue. The directors' worry about financial instability could be addressed by hiring an expert consultant who could investigate the financial transactions and status, thus offering suitable solutions. Raising funds without diluting ownership. When sourcing new capital to support the PSB operations, PSB enjoys the option of debt capital over equity, since issuing more stocks will dilute their ownership stake in the company. PSB can also use borrowed funds to generate more revenues and use the returns to service the debt, without affecting the ownership structure. Cash shortfall. PSB mainly relies on equity capital to finance operations throughout the year and may experience cash shortfalls that affect the normal operations of the company. The best remedy for such a situation is to seek additional cash from lenders to finance the operations. Debt capital is readily available from financial institutions and investors as long as PSB appears financially sound. Investment capital. PSB may require a large amount of capital to finance major investments such as acquiring a competitor firm or purchasing the essential assets of a firm that is exiting the market. Such investments require urgent action and shareholders may not be in a position to raise the required capital, due to time limitations. If the business is on good terms with its creditors, it may obtain large amounts of capital quickly as long as it meets the loan requirements. Forecasting cash flow. Many businesses, especially high-growth ones with healthy balance sheets, diligently forecast their profit and loss but often neglect to forecast their cash flow because illiquidity has never been a concern. However, PSB must regularly forecast cash flow in tandem with its other financial performance projections. A robust cash flow forecast will not only help PSB avoid having liquidity issues when they unexpectedly face higher than normal expenses but also reconcile the two key financial parameters of cash flow and profit. No matter how large a profit a PSB makes, if it cannot convert that profit into cash, it will not be able to meet financial obligations such as covering payroll, paying for inventory, increasing liquidity, and avoiding insolvency risk. Regular cash flow forecasting also forces businesses to better optimize net working capital to meet long-term financial goals. Monitoring and optimizing net working capital. Financial professionals need to have an in-depth understanding of how business fluctuations affect financing and net working capital requirements. Improvements to working capital can be achieved through three-statement projections and analysis of financial ratios such as days sales outstanding, DSO, days payable outstanding, DPO, and days inventory outstanding, DO. Cash conversion cycle, CCC. CCC measures the average number of days PSB takes to convert its resources into cash flow. CCC is calculated based on the sum of DSO and DO, less DPO. CCC evaluates operations and management efficiency because it provides stakeholders with insights as to how long the business takes to realize cash flow from its investments in sales and production processes. A lower CCC value usually indicates that the business is efficient in managing its operations and vice versa. Managing existing credit facilities. The use of borrowed capital helps a business grow and be profitable because it gives it the ability to manage short-term and long-term needs such as bolstering its cash reserves for future net working capital requirements and capital expenditure investments. Risks of financial leverage. Although financial leverage may result in enhanced earnings for PSB, it may also result in disproportionate losses. Losses may occur when the interest expense payments for the asset overwhelm the borrower because the returns from the asset are not sufficient. This may occur when the asset declines in value or interest rates rise to unmanageable levels. The volatility of stock price. Increased amounts of financial leverage may result in large swings in PSB profits. As a result, the company's stock price will rise and fall more frequently, and it will hinder the proper accounting of stock options owned by PSB employees. Increased stock prices will mean that the PSB will pay higher interest to the shareholders. Bankruptcy. In a business where there are low barriers to entry, revenues and profits are more likely to fluctuate than in a business with high barriers to entry. The fluctuations in revenues may easily push PSB into bankruptcy since it will be unable to meet its rising debt obligations and pay its operating expenses. With looming unpaid debts, Creditors may file a case at the bankruptcy court to have the business assets auctioned to retrieve their owed debts. Reduced access to more debts. When lending out money to companies, financial providers assess the firm's level of financial leverage. For companies with a high debt-to-equity ratio, lenders are less likely to advance additional funds since there is a higher risk of default. However, if PSB agrees to advance funds to a highly leveraged firm, it will lend out at a higher interest rate that is sufficient to compensate for the higher risk of default. Financial ratio analysis can mark how a company is performing over time while comparing a company to another within the same industry or sector. Financial ratios have been recognized for their capabilities in enabling management to evaluate their company's financial performance to the analyst and management divisions. However, it sometimes has a limitation when sent wrong analysis of the financial health and performance of the business. But financial ratios can also be the best references in explaining what has happened in the past and can help the management and financial analysts to understand business trends. While some trends can help illustrate the future of a business that may seem, in another part this ratio still cannot give a real forecast for the business. It is to be concluded for this study that this is very difficult to decide on any of the company's performance and the measurement tools because all the formulas and functions are applied to attain a specific requirement of the company as part of the company's financial strategy. So, the qualitative information will also need to understand the purpose of the company to use any of the tools to measure their performance. Finally, it could be recommended that the importance of the ratio analysis depends on the stakeholders' specific needs and situational requirements.